Good morning. Welcome. Dr. Stephen McMullen excuse me, earned his PhD in economics from the University of North Carolina and began teaching economics at Hope in 2014. He teaches microeconomics and macroeconomic theory courses and the history of economic thought. One of Stephen's academic passions is to explore Christian thinking about economics, and he serves as executive editor of the journal Faith and Economics. Much of his recent academic work lies at the intersection of moral philosophy and economics. He has published numerous articles on environmental ethics, animal ethics, and technology. His current book project is a debate about redistribution and the welfare state. Welcome, Stephen McMullen.
Thank you. It's really a pleasure to be here. I was telling my daughters as I drove them to school today that I got to do this presentation today, and they were asking questions about HASP, and I said it's just the best audience I have all year long. Normally the questions I get when I teach about this stuff are like, is it going to be on the test? And I said, but there's always a risk with HASP that someone in the room has been a banker for 40 years and knows it better than I do. So it is a real pleasure to be back. And I haven't talked about this stuff with a group like this in a presentation this size before. So I honestly don't know how long it will take to get through the material that I've prepared. But I think it's about right that we'll have a nice long time for questions. And I think it should fit. What I want to do here today is to kind of do a couple of different things, because I think the audience is going to probably have a diverse set of background and experiences thinking about economic data. And so I want to, on the one hand, give you kind of as up-to-date a picture as I can about government debt, government spending, the government budget, kind of sort of big picture stuff, and think through the consequences of government borrowing, government debt. But at the same time, I want to try to explain along the way what kind of data we're looking at, the basic principles, the basic concerns. So hopefully, those of you who are used to thinking about economic data already, you'll get an updated picture of where we're at. And those of you for whom this is all pretty foreign, hopefully you'll also be able to learn how we measure some of these things and where we're at, and the basic principles and basic concerns involved. So I want to try to do both of those things. The PowerPoint is going to be mostly, there's going to be some text on there, some big ideas, but mostly I'll use the PowerPoint to show you the most up-to-date graphs that I can of recent trends, recent history, and what's going on today. And so you'll see a lot of very similar line graphs, and I'll try to talk you through them as we go.
Okay, great. Thanks.
All right, so the outline of what I want to do, though.
Favors.
I've been particularly interested in questions about government spending, government borrowing, the consequences for our economy for a couple of years now, in part because we've been going through what can only be described just kind of a wild experiment. Policy-wise, we're pushing the limits of government spending and government borrowing much further than we have, certainly over our lifetimes. And with the caveat, maybe like debt levels were higher during World War II, right? But that's the most recent analog. And that has forced economists to ask a lot of questions. We actually don't know what some of the limits are, and we've been trying things out, for better or for worse, and learning something about what the economy can handle and what it can't. And so it's really interesting to just sit down and try to lay out first the basics of government borrowing, the deficit, the national debt. Like, where are we at? Where have we been? How do we compare the kind of debt that the US government has now to where we were 10 years ago, 20 years ago, 50 years ago? But then to spend a bunch of the time thinking through what I think are the three big concerns that we have about government borrowing, right? And the first is just going to be the cost of the debt in terms of our government's ability to pay bills, and the cost that we push off to future years. I'll try to sort of put some numbers on that. The second problem would be that government borrowing just pulls money out of the economy that could be going to other purposes. I'll explain how this theory goes. This is something I have to teach in class in some detail. It's a little bit abstract, but the nutshell version would be if government does too much, it'll crowd out other activity, private activity that would be really valuable. And then the last concern is inflation. This is a particularly interesting topic to hit right now because for the first time in my life, inflation is an interesting and pressing thing. I shouldn't say that, not the first time in my life, but last time that inflation was a really big problem in our economy, I was too young to know what inflation was. So as a teacher, this is the first year in which I'm teaching about inflation, and it's actually a problem. And so we'll spend some time thinking about the connection between inflation and the government activity as well. And then I'll finish with what am I concerned about right now? Like, what am I watching for? What makes me worry? It's nothing's keeping me up at night, but what concerns me? And then we can also talk, hopefully have a lot of time for questions at that point about how we should think about these broader trends. Now, quick order of business. When we're talking about this stuff, I might run over something too fast, or I might raise something that you think is really interesting along the way. I think it would be best if you ask questions immediately during my presentation, or maybe at the end of my sentence or something of the sort, but not waiting till the end. And I think that's important because as I'm flipping through topics, it'll probably be best if particularly any clarifying questions about the data that we're talking about or the way we're measuring government debt or something of the sort, best to have those out of the way right away, right? I don't want to have you wondering what I'm talking about all the way to the end. So raise your hand. I'll finish my thought and I'll try to hit questions right away. And then if there's a question online and you want to put it in the text, I trust that there's someone who's monitoring that and will alert me to it because I can't see it here. Sound good? We got it? Yeah, and we do have a microphone as well. So the other thing, of course, and you're probably used to this, but if you do have a question in the room, wait for the microphone to come to you so that the folks online can hear you talk. All right? Okay. Let's start with the basics. I grew up worrying about the national debt in a kind of vague existential way, thinking that this was probably going to ruin my adulthood before I understood much about economics. And now I'm still worried about the national debt. I'm more worried that it will ruin my children's adulthood than mine. But let's look at the numbers because they're big. All right, so this is maybe one of the most boring graphs I could possibly show you. It's just an upward sloping line. It starts at a really low number, ends at a really high number. But let's just take a look at recent history. This goes back to 1980, and it shows you the rise in the national debt. So this is total public debt. It's money that the US federal government owes to somebody else. What I want to point out, that the thing that I think is worth noting here right from the get-go, and there's more data that I'll show you that's more useful than this, is just that we have not had a moment in my lifetime in which the national debt wasn't getting worse, right? So this is a long-term problem. It's a structural problem in the sense that debt has been increasing in terms of raw numbers. But particularly in the very recent period, as you all probably know, since the beginning of the COVID-19 pandemic, government debt has increased faster than at any other point in my life, right? And we see that at the very end on the far right side of the graph, this big spike in debt during the pandemic when the government used its power to send money to people to try to sort of limit the economic damage of the pandemic. That resulted in a really dramatic amount of spending in a very short period of time. All right, but this is actually not the most useful way of thinking about, oh, and I should talk about the magnitude here, but thinking about the total amount of money the national government or the federal government owes is probably best thought about a little different. So this graph, it shows you the same data, but I've done some adjustments. The first thing is we're looking now at federal debt as a percentage of the size of our economy, as a percentage of GDP. So you can think of this, if we were at 100%, then that means the total amount of money we owe is equal to the total value of all goods and services produced in the US in a year, right? So everyone would have to give a full year's income in the entire country in order to pay off the debt. That'd be 100. We're actually not at 100. In other ways of measuring it, we would be. I'll talk about that. But we're ranging from 20 at the beginning in the 1980s up to now we're above 70% of GDP. Now, there's two other adjustments I've made that make this line lower than it might otherwise have been. The first thing I did is I pulled out the debt that is held by the Social Security Administration. So the US federal government owes the US federal government money, right? And if you count that debt in here, it looks a lot higher. I think there'd be a reasonable argument for counting that as government debt because it's a future liability to Social Security payments. But for the kind of stuff we're talking about here today, I think it's fine to say that's one part of the government owing the other part of the government money. It's not debt that the government services in paying interest to someone else. So it's a little bit different. The other thing I pulled out of this was the assets of the Federal Reserve, which is also really big. It's about a quarter of US debt now. And the reason I pull that off is because the Federal Reserve owns a lot of debt, that meaning the US federal government owes the Federal Reserve lots and lots of money. But when the Federal Reserve earns interest on that debt, they use it to fund their purposes and their operations, but then all of the extra they give back to the US federal government. So then it gets added to our ability to spend money on things. So in some sense, that's not the same kind of liability either. So when I pull out the money that the US federal government owes to other parts of the US federal government, this is what we got. And now what we actually see is there are periods of time in which we have declining US government debt over my lifetime. So if we look at the period when I was in, I guess this would be my high school years in the 1990s, debt to GDP ratio was falling. What was going on there is the economy was growing really fast. And at the same time, our budget deficits were lower. You may remember a brief period in the late 1990s in which we're actually talking about a government budget surplus, right? And this was during sort of the end of the Clinton era. And there was all this discussion about what we do with it. It was a weird time to be alive, right? But anyway, so that's in the late 90s. And then we've had periods in which the debt has grown at about the same rate as GDP. That's periods like in kind of the 2000 to 2008 period. And then again from say, looks like 2012 to a few years ago. But then we have periods of increased debt. And the most notable are, of course, the most recent two recessions, right? 2020, like in the COVID-19 pandemic, you can see that spike, but also in the 2008, 2009 financial crisis, dramatic increases in debt. And generally speaking, debt increases most dramatically when we go into a recession. We don't see that in the 2001 recession, but that one was really small. You all remember it was right after the 9/11 attacks. It almost didn't count as a recession. I mean, it was in terms of economic data, it was very small. In every other recession in my lifetime, we have seen increases in government debt. We can talk about why that's the case, but let's push that on a little bit. But now what we're dealing with, I think the take home is that we have a situation now in which the US federal government owes to people outside the government, people in the US and outside the US, about 70% the size of our economy, which is a mind-boggling amount of money, but then our economy is mind-bogglingly large, so it kind of works out. Yeah. Oh, let's wait for the microphone. Quick question.
And I have something in chat after this question is addressed.
Sounds good. This is a great time to answer questions.
And do we know what fraction of the debt is owed to Americans and to American citizens, and what fraction to non-American citizens?
You know, that's great. We do know, and I do not. So I could find that information for you relatively quickly. There are possible futures in which that could be very important, and we can talk about that. suffice it to say, so first note, I pulled all of these data from the St. Louis Federal Reserve. They have a publicly accessible data archive that's really good. My daughters think it's magic when I start playing with the graphs. And at the end, I could actually pull up those numbers relatively quickly. When would it matter that we owe money to someone else and not to an American? You know, that the worst case scenario would be something like if a government like China, which owns a lot of US government bonds. People all over the world own a lot of US government bonds because US government bonds are considered among the most stable, lowest risk places to put your money for folks all over the world, and they're easily accessible, easy to trade. So if you're looking for the safest place to put your money, often people will buy bonds. Well, this is also true of foreign governments. And I guess the worst case scenario would be a foreign government dumping US bonds in a really dramatic way all at once and messing with markets. Right now, it would be really difficult to pull that kind of move because the market for US bonds is so big, and it would be very difficult even for a government the size of China to make that kind of thing and have a real big impact on the US economy without also suffering extraordinary losses. But that's the only sort of immediate danger that I could imagine would be some kind of currency crisis initiated by a big move by a foreign government.
Thank you. I do have 3 questions in chat, and
All
let's
right.
do one, let you move on, and then I'll catch up a little bit later. But the first one is the national debt chart is not adjusted for inflation. A loaf of bread was much cheaper in 1980. How would the chart look if it was based on inflation?
This is great. I meant to talk about that. Oh, sorry, is there more to the question?
No,
All
that
right.
is
So
it.
one of the problems actually with this picture is that it is not adjusted for inflation. And I was thinking about showing you an inflation adjusted chart. It goes up, it just goes up slower. But the reason I didn't is because one of the adjustments that's kind of baked into dividing or thinking about debt as a ratio to GDP is that we don't actually have to adjust for inflation for this graph. And the reason is because we're looking at a ratio, and both the top and the bottom of the fraction are both using the same dollar values. So you can think of inflation as just changing the units on the currency over time. And as long as we're dividing with the same units at the top and the bottom, this graph effectively adjusts for inflation in that way, because it's really looking at a ratio. It's not looking at dollar values anymore. As a mathematical note, but you're right. For this chart here, if we were to make any real sense of the numbers, we should adjust them for inflation. All right. One more. Oh, sorry, another question? Yeah, let's do that one before I switch gears here.
Yeah, I remember what I was trying to say. Yes, you know, when the World Monetary Fund loans money to these third world countries, what kind of percentage are they alarmed at? I mean, say you didn't have
yeah.
our economy, our country's name on this debt load. Some of these higher numbers I seem to remember reading, and I vaguely read The Economist about these sorts of things. And that's kind of when they don't like those sort of numbers of debt to, of the, you know.
This is a great point. So for years,
Third
the
world.
International Monetary Fund has had these recommendations for countries about when your debt is too big and when you need to restructure your tax system or something. And you know, the numbers that we offered for years as advice would be something like 50, 70, 100% of GDP. And the US, if I measured this a little different, would be, if I included the debt the US government owes to other parts of the US government, for instance, this would be up above 100. So we are nearing those benchmarks. And one thing I could tell you is that there actually has been a shift among economists thinking about how dangerous it is to have large amounts of debt. I worry a little bit that economists have an incentive sometimes to be less worried about something that the federal government is currently doing. And there's an incentive to say, yeah, no, it's okay. It's all right. Please give me that government job. But nevertheless, there's some reasons why we would be less worried about 100%, say, if we got up to 100%, even in these numbers of GDP in US debt. There's a couple of reasons we'd be slightly less worried in the US than in some other places. One would be we have a pretty good tax system. So if you had a really high debt to GDP ratio in a country that had a really unreliable ability to collect taxes, then that can be a real problem, right? Because then there actually is no reliable way out of it. The other two places would be if you had a government that was very likely to start printing money and inflate their way out of the debt. We'll talk about that later. That would be a big problem. The US has made a credible commitment, hopefully, not to do that. At least investors don't seem to believe that that's a big issue right now. We'll talk about that when we get to the inflation thing as well. The last thing would be that if you had a government that looked like they were likely to default on the debt. And right now, nobody thinks the US is likely to do that in the near future. But those are the big red flags, right? So we're less worried about the US, but there's one other big reason why we're less worried about high amounts of debt right now that I want to save for a few slides. That has to do with interest rates. All right, so let's think about where this debt comes from. So one way of thinking about this is to ask how much new debt are we adding every year, which is basically the same way of asking what's the annual federal government budget deficit, right? So we hear talk about the deficit and the debt. And I always have to remind my students that the debt is like the total accumulated amount that we owe to other people. And the deficit is the new debt that we're incurring in a given year because we decide to spend more money than we collect in revenue from various sources. So one way of looking at those deficits is just to look at the change in government debt. And this would be, sometimes it's negative because we're paying off debt slow or faster than we're accruing new debt in a few years. But generally speaking, or as a percentage of gross domestic product, so the line is going down. We're not actually never decreasing our total amount of debt much. But then what we see here, I think most notably, is the effect of recessions. So, and this is a political arrangement in the US, or a kind of tacit agreement that when we have a recession, we have enacted policies that are Keynesian in this way. When we go into recession, we have policies that spend a lot more money when we're in a recession, right? We've made this as a conscious decision. There's a lot of reasons why this is good policy. It helps smooth out the economic ups and downs. But the impact of this, you can see here. Most of the big increases in debt come where those gray shaded lines are on the graph. And by convention, I should have told you this graphs ago, those gray shaded lines are how we mark out recessions, right? So we can see the very short but significant recession from 2021, the 2008-2009 financial crisis, right? The 2001 recession, and then we can go back to 92, and then the two recessions in the early 80s. Of course, we could go back further, but I've chosen for most of these graphs to stick to like 1980 onward. You'll also notice a trend here, though. There's a change over my lifetime. While I've been watching economics and teaching it to a large degree, we've seen a change in the U.S. federal government's attitude about how to respond to recessions. And the change in the attitude has been that we now respond to recessions much more aggressively by doing a lot more government spending. In the most recent recession, of course, the government just keeps sending us checks, and it was a lot. That's also happened in 2008-2009 recession. You remember the big stimulus bill, perhaps, in 2009. Most of that was government spending on like public projects, right? But by the time 2021 comes around, most of it is, there's still a lot of that, but a lot of it is checks being sent out to people and expanded unemployment benefits and these kinds of things. So you could just see the magnitude of the change in government practice on this graph in that earlier recessions in my lifetime, we did have an increase in government spending, but it wasn't as dramatic. The increase in government spending in early recessions, it might be a targeted tax cut that happened in the 2001 recession. George W. Bush actually had a tax rebate. I think it was like $500. It was a small thing. But in every recession, we get increased government spending on unemployment benefits, increased government spending on Medicaid, on food stamps, right? And so on all these things, spending goes up a little bit. And at the same time, in a recession, government revenues fall. People are earning less money. People are losing their jobs, so they're paying less in taxes, right? Firms are going out of business. Profits are down, so taxes are down. And so that combination, lower revenue and higher spending in a recession always means that the government deficit is jumping. And in every other period, almost every other period, you'll note along here, there's kind of a trend of declining new debt to GDP in this graph, which means most of what's going on here is we're spending a whole bunch of money in recessions, and then we're never really paying it back during the good times, more or less. The exception is you can see the increase right here in government debt as a percentage of GDP, which I think I'd have to check my numbers, but it looks like that corresponds to the Tax Cut and Jobs Act, right? So it was a decrease in corporate taxes and some other tax revenues right at the beginning of the Trump administration. Okay. I think we need to talk about this political thing a little bit more later, but I think that's the general picture I want to paint, is that our increase in government debt has a lot to do with the way we respond to recessions. Yes, sir.
Say we have a couple whose combined income is $100,000 and they have a $200,000 mortgage and maybe some car payments as well.
Yep.
So their debt is double their annual income. You said the federal deficit right now, the federal debt is 70% of GDP. Is it fair to compare the example I just gave with that number?
You know, that's an interesting question. Yes and no. So there's two ways you could do that kind of comparison. And then there's a reason why the comparison probably doesn't make a lot of sense. So one way you could compare US federal government debt to GDP, which is what I've been doing. And that's comparing it something like to our capacity to pay it off in some sense, with the caveat that, of course, we couldn't pay it off all at once or we'd starve. But the other option would be something like comparing government debt to the size of the US government budget or revenue, which might be a closer analogy. And then the question would be, based on the US federal government's income in a year, all right, how many years would it take, right, to pay it off? And then the numbers would look a lot worse, because US federal government is, oh geez, I shouldn't pull numbers out of my head. I'm thinking it's something like 20% of the US economy. So then we'd be multiplying this ratio by 5 if we did debt to as a ratio of this total size of the US federal government, as opposed to the whole US economy. Now there's reasons why that analogy is sometimes helpful in thinking about sort of basic kind of responsibility in government spending, but there's some places where it doesn't fit. One, of course, is that the US federal government has the ability to print money, which they don't let me do. And the other thing, of course, is that they can change their income and spending as a matter of policy. So there's just more latitude to control levels of debt, so that holding debt is more of a choice for the US federal government than it is for me as an individual. In some sense, I could choose to pay off debt more quickly or more slowly, but I can't just say, you know what, I'm going to charge Hope College more for my services this year and just, raise that revenue just because I think it would be a wise thing to do for my finances. I should say I can do that, but my dean would probably disagree with me. Whereas when the US federal government decides to raise taxes, they are making that kind of choice. So there's just more latitude. And so holding a large amount of debt is more of a choice for the US federal government than it is for the average household. So I think of rising debt levels as more of a question of, I don't know, it's just different. The one last thing I'd note is that the federal government can borrow money way cheaper than a household can, like dramatically cheaper. And I'll show you some of the interest rates. And that also makes a huge difference for what kind of debt levels are reasonable. If you could take out a home loan at less than 1%, then it would be reasonable to have a much more expensive house. And that's basically the rate at which the US federal government is borrowing money right now. All right, so this is change in government debt. Here's a different way of looking at the same numbers. This is just the government budget deficit. For the purposes here, I decided to go back a long way. Again, this is still a percentage of GDP. And I decided to go back before World War II here so that we could make the explicit comparison for the whole period in which we have good data that's comparable. And so you see going all the way back to the left side of the graph, the recession here is, of course, the Great Depression in the 1930s. We have the big increase in government debt in the 1940s for the war effort. And as a percentage of GDP, it really was staggering, right? And I mean, in terms of in the economic data, it still stands out in just a wild way. The degree to which the U.S. mobilized financially for the war, I honestly don't know how we would pull it off again today. It was kind of amazing. And then you see this period with real stability in terms of debt in the middle part of the 20th century. And then the rising deficits through the period we've been looking at. So the deficits just become sort of regularly quite large as a percentage of the size of the economy, and have really hit since World War II pretty historic levels in the last couple of years. So this is, like I said, this is just one more way of looking at the data we've already looked at. Any line below zero is the degree to which the U.S. is borrowing money to fund its normal activities. Okay, any clarifying questions on this one before I move on? Good. So that's all I wanted to show you for the basics of government debt and deficits is this basic pattern: rising debt, increasing size of government deficits, even when there isn't a major crisis, but particularly when there is a crisis. And we were responding to economic crises, in particular in recent history, with bigger and bigger increases in government spending. Right? That's been the norm. It's difficult to say at this point whether or not the COVID-19 crisis has created a new expectation of really dramatic government spending in recessions. We won't know that until the next recession. But it seems like it might politically be difficult to rewind that one. The political incentives, I think, to send out checks in the next recession, I think will be very strong. Yeah.
Just curious about the rise in numbers of employees of the federal government and the debt. How that, I know there's got to be some graphs. Economists loves graphs.
I do. You might be able to tell this, but I do actually love graphs. And preparing this was great fun. But I don't have that one. So we could talk about total levels of government spending, and we could as a piece of that ask what percentage of government spending or how much government is spending on just staffing and employees and just the size of the federal government. Yeah, I mean, the government has grown over our lifetimes. It's grown pretty dramatically, slowly, steadily. I think every administration, no matter what they say about whether or not they love or dislike the government grows. It's an inexorable force. I don't have that. So I decided in what I was going to focus on today, I decided that I wasn't actually going to dive into the should we be spending money on these things question. It's just a totally different question, right? Or what is the right tax rate? What, or something like that. Instead, I wanted to focus on the monetary side and about debt and deficits, interest rates, inflation. Yeah.
This may be a little off the path, but there's something I read a little bit about MMT, modern monetary theory, which basically says, I think, that as long as we can produce things to be purchased by people, that we can print money without limit, as long as we are in control of the monetary system itself.
I'm glad you brought that up. In my original plan for this presentation, the last topic I was going to cover was modern monetary theory, which is the idea you're referring to. It's and you're right. I'd like to think about this when we get to the inflation at the end. But there is the short version is there's been a very highly publicized and sort of public challenge to standard macroeconomic theory coming largely from the left. One economist that's quite famous for this is a woman named Stephanie Kelton. She's been an advisor to the Bernie Sanders campaign. And the message is basically that we should worry less about debt. And the government shouldn't be afraid to print money unless it's causing inflation. Now, there's a way in which modern monetary theory is not really very different than their recommendations aren't that different than what standard macroeconomics has been saying for quite some time, which is that the reason we don't print money is because we're worried about inflation. And the modern monetary theory people say, well, just don't worry about government debt. Just print money when you can, but then you do have to be worried about inflation. So there's a slight change in the way they think about the underlying accounting in the federal government and whatnot. But let's hold off on that. There is a very different sort of policy vision being offered by them, and the big lesson that they are trying to offer is that when the government can print money, debt is really just one way of paying for things. And as long as we have the capacity to produce things, like you said, as long as we don't print money too fast, we shouldn't worry about the difference between debt and printing money. I think that these are more similar. I don't want to go too far down that rabbit hole. Let's hold off on that though, and we might be able to come back to it. Okay, so what I want to do, and this is the real point, I think, everything I've done so far, I hope was setting the stage so that we're kind of all on the same page about recent trends in borrowing and government debt, so that now we can think through what I think are the three biggest concerns that we might have about government borrowing. And we're going to do these in order, and from I think the most straightforward to the most tenuous. The most obvious and I think very serious problem with increasing government debt is just that we have to pay that money back. And when we borrow money, it means that in future years, a bigger and bigger part of the US federal government budget is paying off that debt, right? No different than a home loan or student loans or car loans. And this is one handy graph. This is produced by a group with an agenda. Their name is the Committee for a Responsible Federal Budget. And their goal is to get people in Washington to start thinking more seriously about the debt. And so what they've done here very helpfully, I'm going to show two figures that they produced in a report, and I can give you the link to that later. But two figures that just show the amount of money we're paying just the amount of the US federal government budget every year that just goes to servicing the debt we already have, right? Not decreasing the level of debt, just making payments, like break-even payments on the debt that we have. And it's, this year at current interest rates, it's $300 billion a year, which they helpfully compare that to some other things. Like if we didn't have the debt we have, you could say we could double all food support to Americans and have a little money left over. We could, right, that's food stamps. So that's this line down here. We could double easily what we're doing. Alternatively, we could double the money that's going to disability insurance or transportation budgets from the federal government. You can see housing support, all federal money to K-12 education, which is actually a very small amount of the total money we put in K-12. Most of it's local, right? Social SSI, that's Social Security insurance. That's not the Social Security program more broadly. But you can see, like, compared to a lot of these other things that we put a lot of money into, the debt payment is a really big chunk of what the US federal government does. And that's 300, given a certain amount of tax revenue, that's 300 billion that we could be spending on something else. And any government program that you like, or that you think the US federal government should have, almost any program on offer, maybe not some of the Medicare proposals, would probably be, we could pay for it, right, with a lower number there. Yeah.
I see the vet and military retirement are on there, but I don't see anything for military paying the building of weapons, etc.
Yeah,
we take on.
I think, is that on the next graph? Yeah, that is in the next one. That's actually a much bigger number. So this, this does a very nice comparison. The one thing is, of course, they're trying to make a point here, and the point is these debt payments are really big. What they don't show you is the government programs that actually cost more than our interest payments, and so I've included that in the next one. The big programs that cost more than our interest payments are Medicare, Medicaid, Social Security, and then the defense budget in terms of big categories, right? And it's not, I mean, it's this is what the US federal government does. Some people joke that the US federal government today is an insurance company with a military. And that's not too far off. That's in terms of the total dollars, right? These programs swamp everything else the US federal government does.
The $303 billion of money goes back, much of it back into our economy, does it not?
You know, it's payments, it's interest payments to whoever is holding the debt. So a certain amount of that is actually going back to the US federal government. It's going to the Federal Reserve and it's going to the Social Security Administration. And that's it's like 40%, 30 to 40% of US government debt the US government owes to the US government. I don't know. There's some accountant out there who's paid a lot of money to understand this. I don't always, but then the bulk of it, then like 60+% is owned by the public, which is the numbers I've been showing you, is debt to the public. And that is both, that's investors all over the world. A huge chunk of it is held by banks. So if you're a banker and you have someone make a deposit and you want to do something with that money, and one of the safest things you can do with those deposits is to buy US government bonds, right? And so a lot banks hold very big, they hold a lot of US government debt as an asset. But then also foreign governments and foreign investors, and most of us in retirement savings have probably some of our portfolio in government bonds as well. Does that help? But that's where the interest payments are going. It's servicing those. And so, I mean, the mechanics are just that when a bond matures, the US federal government pays it off. And then if they still need the money, they just issue a new bond. And so you can think of this 303 billion as sort of the maintenance payments, just to keep the debt level the place it is.
Yeah, I have a couple questions that I put on hold until right now, but somebody commented that it seems weird that we owe so much money, but are considered to be the wealthiest country. Another person commented that this presentation should be required watching for every high school student. And here comes
I would agree. Sure,
and here comes the question. If economic growth is based upon productivity improvements, why do basic commodities continue to increase in costs? Seems like money is continuously devalued since we are no longer on gold standard.
Okay, so let me think here. So commodity, productivity, gold. So first off, I'd contend that the premise of the question isn't exactly right. So in very recent years, commodity prices have gone up dramatically. Over the last 80 to 100 years, the price of food relative to, or adjusted for inflation, we can talk about inflation in a second, but adjusted for inflation, the price of food is actually much lower. The price of just about all manufactured goods is lower, particularly as a fraction of what people are earning. The average person in 1900 was spending a relatively big chunk of their money on food and clothing and basic manufactured goods. And now food and clothing is a smaller and smaller part of the average person's budget. And a lot of that comes from increased productivity. So our agricultural sector, the increased productivity over the last 100 years is kind of stunning when you consider the fact that they're running right up against the limits of the created world, right? And ask, I mean, you might have thought that you couldn't squeeze more chickens out of an egg, but they've done a really good job. The number of chickens coming out of eggs is just dramatically bigger than it was 100 years ago. And the number of workers per chicken is just dramatically lower. And so I would just say, first off, putting aside the gold standard for just a second, first off, there are commodity prices that have gone up, but there's a lot of basic expenses that have gone down. The things that have become more expensive in recent years are services. It's education and it's health insurance and it's paying for a mechanic. Is anytime you need to pay a professional to give you one-on-one attention, those are the things that are becoming most expensive over the last 50 years relative to other prices. Now, productivity does drive growth. That part of the question was exactly right. And we have seen really dramatic increases in productivity over the last 100 years, and that's partly driven really considerable growth.
I'm going to turn off the lights to help people see the screens because you have a lot of great information. It should not affect the people at home, but I just wanted to give you a fair warning.
That's cool.
Lights are going off.
There was one other part of that question that I thought was really good. The gold standard. Yeah, I was still dodging that one. There was one more.
If economic growth is based upon productivity improvements, why do basic commodities continue to increase in cost? Seems like money is continuously devalued since we are no longer on the gold standard.
Yeah. All right, maybe I imagined it. All right, so gold standard. Okay, so the gold standard we were on the gold standard in one form or another until, we were on the gold standard for much of early US monetary history. It was reestablished after World War II as part of the Bretton Woods system. And then we went off the gold standard before I was born. I want to say it's the 1960s, but I'm blanking on the year. It could have been early 70s, but it was in that era, and it was in part because, sorry, it was Nixon. Okay, all right, that sounds right to me. And two things. First of all, the gold standard became very difficult to maintain, and there are still proponents of the gold standard, but in part or some kind of commodity basis for money as a way of offering a kind of stability for the value of the dollar. It's worth noting, though, that the gold standard didn't do a great job of preventing the U.S. federal government from printing money, first off. Because when we went off the gold standard, it was largely because the US federal government could no longer claim that they had enough gold. But that was because they had been ignoring the amount of, more or less, acquiring new gold to support new money. And that's really easy to do. So the question of printing money is actually, like, that disciplinary question is kind of independent of whether or not you have gold at the basis, unless you create some really strong legal requirement to buy the gold. The other thing to note is that the gold standard assumes that the value of gold is stable, but it really isn't, right? So it does provide a kind of basis, but it's a basis that itself is super volatile. So the value of gold moves all over the place. And in particular, the value of gold skyrockets when there's uncertainty in the economy. People want to buy gold as a kind of safe asset. And that means that it doesn't always provide the kind of stability that folks hope it would for a monetary system. There's more that can be said, but I think the big point is that monetary discipline is an important thing, whether or not you have gold as your basis, and that the gold doesn't guarantee it unless you were to, like, write it into the Constitution or something, which is unlikely. All right, so there's another point that I wanted to point out on this particular figure that I really like, and that is, first off, it shows how much we're spending on various government programs, which is always interesting. And as a reference, you can think of our interest payments on debt at current interest rates as being something like 3/5 of the size of Medicaid, right? Half the size of Medicare, a third of the size of the Social Security program. So that's big, right? That's in the big things the federal government does. If you want to do a high level, 5 or 6 big things the U.S. federal government does, one of them is paying off interest on past debt. The other thing to note here, though, that I think is really valuable is that 303 billion number is only 303 billion because we have very low interest rates right now. And I'm going to transition into talking about interest rates. But this graph shows you what the US federal government debt payments would be if interest rates went up only by 1%. That is the interest rate that the US federal government has to pay on its own debt, which is now less than 1%. If that went up to 1.5%, say 1% higher, then we'd be at $530 billion a year. If it was just 2% higher, which historically wouldn't actually be that weird, right? If it was just 2% higher, we'd be looking at $750 billion a year, 3%, 975. And so this shows in part why the US federal government has been able to borrow the volume of money it has, is that we're making interest payments that are so low by historic standards that we can afford it. But if that were to change, right? This is one of the big concerns I'll give you at the end. If we were in a world with higher interest rates for underlying structural reasons, it would be far more expensive for the US government to hold the level of debt that it does right now. And if you are a country that doesn't have that cannot borrow at the interest rates the US federal government has, because people think that the government isn't as stable, they're less likely to pay it back, and so there's a risk premium in there. Well, then those countries don't have the ability to borrow these amounts of money because the debt payments are so much higher. So that, I think that's an important point. And this is one of the biggest things that has changed the way economists think about government debt, is that economists many have come to believe that we are in and will be in a kind of a long period of permanently lowish interest rates, that the middle of the 20th century was just a different economic era in terms of the underlying financial markets, and that money will be relatively cheap for the foreseeable future. And if you believe that interest rates are low, but also will remain low for the next 20 years, then government debt levels are just not as worrisome, right? But if you believe that those interest rates are going to go up again, and some economists believe that, well, then you'd be a lot more worried about the debt. So that has become one of the big dividing points between economists today about how worried folks are about debt levels. All right, this is not moving. Why is this not moving? Nice. You wanna sit in the back of my class? You'd be very helpful. The other day, I had middle class. I had to just give up on the computer, restart the thing just to keep class going because everything was going haywire. And okay, anyway, you all know. All right. So this is the first big concern with government debt, is just we got to pay it off, and it's really expensive. And the higher interest rates, the bigger those payments. The higher the debt, the bigger those payments. And that just means that we can't do as many other things that we want to do with the U.S. government. Now we're moving into more of an abstract thing. The other sort of big worry about government debt is that when the government decides to borrow a lot of money, there's a sense in which it's not free because we have to pay it back. But there's another sense in which it's not free money. It's not as easy as you might think, because that money the government has to borrow has to come from somewhere. And the easiest way to understand this is to think about like a fixed, it's not really fixed, but think about a fixed pool of money that's waiting out there to be lent to people. And it comes from savings. So we all put money into savings accounts, we put it into the bank, we put it into the bond market and the stock market, and other kinds of ways we save money. But then when the government decides to borrow more money, they have to dip into that pool of money that's available to loan out to folks and say, actually, we want to convince people to put some of that into US government bonds. Now, that's not a hard sell. US federal government is a really safe investment. They just offer a slightly higher interest rate, and banks and people saving money just buy up the bonds real quick. But those savings would have gone somewhere, right? The savings wouldn't have just sat there under people's mattresses, right? Folks don't save money that way very often. Generally speaking, they put it in the bank, they put it in the bond market, they put it in the stock market. And then that money would have funded something, right? And so when we're talking about the cost of government borrowing, one of the costs economists worry about is that an expansion in the size of the government crowds out other economic activity that would have happened, right? So this is where the crowding out term comes from. And what that would look like is a small business going and looking for a loan and finding that taking out a loan is just more expensive, because there's a lot of people trying to borrow money, one of the big ones being the US federal government. Interest rates are a little higher, so they have to spend more money to get out that loan. And they decide, you know what, I can't afford it. I'm not going to open that restaurant because interest rates are just too high right now. I can't afford to make the payments that I would need to get out the loan to start the small business. I think about small businesses. I always think immediately about restaurants, because my brother-in-law owned a pizza parlor. My other brother and sister own a small bakery that they just opened up. And so I have a kind of visceral sense of the fragility of a small business when it's first opening up, and the importance of those debt payments for whether or not the business is viable. And so that's kind of what you can think about on the margin. Interest rates go up, that's what you're losing, probably. Sorry? Hey, I didn't pay you, but that's what we're going to talk about for like the next 4 slides. So this is the big concern. Government borrows a whole bunch of money. Interest rates start to creep up as it's harder to get access to financing, and we lose out on some of that activity. And here's the thing. This is a really important story, and it's also really difficult to think of this as a really hard problem right now, or a constraint that we're actually running up against. I'm not actually worried today that small businesses are getting crowded out by government borrowing. And the reason is because we're not actually seeing those interest rates go up. And we need to talk about that. So that's a motivation for what I just really like to do, and that's talk about interest rates. And normal people don't like to do that, so I have to give you the lead up. Here is a graph of the shortest maturity. This is you can probably not see the statistic or the actual data label that's on all of these, but it's right up here. But this is a 3-month Treasury bill secondary market rate. So you can think of this as the interest rate on the shortest loan at the lowest risk anywhere in the world. It's you're lending money to the US federal government for 3 months. What's the interest rate? What interest rate is the US federal government paying? And it's really close to 0. And in fact, with the current inflation rate, it's negative if we adjusted these for inflation. But notice that that's kind of a new thing. So I'm going back here to looks like the mid 1960s. And what you see is that we are and have been since the 2009 sort of the 2008-2009 financial crisis. We've been in a period of extraordinarily low interest rates for the US federal government. And it increased during sort of the last expansion, but only a little bit, right? By historic levels, even at its peak in like 2000, probably 18, it was still by historic standards very, very low. And now we're back down around 0. So this is first off, this is just a side note, the federal government is getting money almost free right now. And if we accounted for inflation, it would be, in some sense, people are paying the US federal government to hold their money for them. The other thing to note is that this is not an accident. I actually went, yeah, I didn't put this graph on here. So I went right after this one, I went to download the federal funds rate. There's lots of different interest rates out there, obviously, different kinds of loans, different kind of debt, different people borrowing, different lengths of time. But the federal funds rate is an important one for economists and people in the finance world because it's the interest rate that the Federal Reserve targets. So you've probably heard news about the Federal Reserve impacting interest rates. I can't go into all the details about how this works, but the short of it is that the Federal Reserve, when they're deciding to increase or decrease the amount of money in the economy, they do it by watching interest rates in particular. And they target the federal funds rate as sort of the lever that they're trying to move around. And when they want interest rates to go up, they start pulling money out of the economy by selling government bonds until that interest rate rises to the point that they want. When they want interest rates to go down, they start pushing money into the economy by, wait, did I say buying or selling? I always get this mixed up if I don't have my notes. Anyway, they're buying government bonds when they want money going out in the economy, and they're selling government bonds when they want to pull money out. When they increase the money supply, this is how they're doing it. And when they increase the money supply, that pushes down interest rates. Now, this is all to say that they lower the US federal funds rate by pushing money into the economy. And they've pushed the federal funds rate down to 0, basically, or very close. And when I went and downloaded this graph, it was basically what I expected. And that is, it looked exactly like this. So with very small differences that you wouldn't be able to see in this setting, the federal funds rate over the last 15, 20 years follows almost exactly the same pattern as the cheapest federal treasury, which in financial markets makes perfect sense. But suffice it to say, you can think of this graph as being manipulated and planned directly by the Federal Reserve. So what's the first thing to get to the question, what causes interest rates to be so low? The first answer is the Federal Reserve has made a choice to push money into the economy until borrowing money just becomes really, really cheap. Right? If the Federal Reserve is pushing lots and lots of money into the banking system is going to charge lower and lower prices when people ask for loans, and interest rates just keep falling. As long as there's more money to be lent out than people want to borrow. And that's the situation we're in. Banks are just sitting on lots and lots of money in very low risk investments. And they basically have more funds available than people want to borrow. And so interest rates stay very, very low. You can also think of the Federal Reserve, even now after they've announced higher interest rates, even now interest rates are so low that you can think of the Federal Reserve as kind of pushing on the gas still in terms of kind of speeding up the economy. And the announcement they've made recently is just they're slightly letting up on the gas, but they're still probably, the interest rates are still low enough that they're probably still giving us a kind of acceleration. But that means that we have kind of a bigger story. There's probably, there can be questions about this, and I'm happy to answer them. This is like a week in macro econ, is talking about all the details here. But the big picture here is that interest rates are really low because the Federal Reserve has decided to keep interest rates really low. And that Federal Reserve choice is accommodating a lot of government debt. In fact, we often think about the dynamic between government borrowing and a central bank as being either in conflict or sort of pushing in the same direction. And what we've seen is the US federal government is borrowing lots of money, and the Federal Reserve is accommodating it by keeping interest rates really low, despite the government borrowing. So they're kind of working in tandem, right, in terms of giving the economy a bit of a nudge. Okay. Yes and no. So we use printing money kind of as an analogy. It's worth noting because, of course, most of the purchases we make are not paper money. But what the Federal Reserve does is they have access to large amounts of money, and what they're doing is they're taking securities out of the banking system and they're buying them. And in doing so, they're increasing the amount of funds that banks hold as cash. I should say this is the old version of what they did. They've been just messing with our econ textbooks like crazy over the last decade. But the simple version is yes, they're pushing money, new money into banks. It's all electronic, but yes. What they've been doing recently is actually, because banks have been holding on to so much cash, that mechanism isn't very effective anymore. And so they've been buying lots and lots of different kinds of assets in some waves. We call this quantitative easing. That's just buying different kinds of long-term assets. But the other thing they've been doing is they've been lowering the interest rates that banks get when banks put money in the bank's bank, which is the Federal Reserve. All right. So you can think of the banking system as kind of like tiers. And when you put your money in the bank then deposits it with a bigger bank because your local bank can't hold on to all that cash. It's easier for someone else to hold on to it. And the very top bank that's holding deposits for everyone else is the Federal Reserve. So banks are holding their reserves with the Federal Reserve, and the Federal Reserve is paying these banks interest. And they've been lowering that interest rate so that banks have a smaller incentive to hold money in reserves to try to push that money into the economy. But then it's when banks make loans that the total amount of money in the economy is increasing. I didn't actually intend to get into all of that here today, and we can talk about it more. It's infinitely fascinating and weirdly complicated, but also it's like counterintuitive in some weird ways, understanding how money gets pushed into the economy. So there, I've given you the story. If I just totally left you in the dark, I'm sorry. If what I told you was hopelessly simplistic and you know that it's way more complicated than that, I'm sorry. You know, that's true. But the big picture here that I wanted to show you is that its interest rates are low. And in this case, these short-term interest rates are low because the Federal Reserve has pushed them down and tried to keep them there. I should note, though, this is not just the US Federal Reserve that's doing this. It's central banks all over the world have really low interest rates. And so we'll get to this in a little bit. There's some question about whether or not central banks are leading or following underlying dynamics in the market. And I'll talk about that in a second. The other thing to note, though, is that even the long-term debt. So I showed you the short-term debt, 3 months. Long-term debt also has really low interest rates. So I just wanted to show this as well, just to note that this is a 10-year security. The rate of return on a 10-year government bond. Again, it was really high in the 1980s. Inflation was high, and the Federal Reserve was being really aggressive, trying to increase interest rates to. I mean, that was Volcker, right? It was Carter, and then the Reagan administration. And they were fighting inflation. But since then, the interest rate on the 10-year bond US Treasury security has constantly or very consistently fallen to the point where it's now, again, at historic lows. And so the federal government could borrow money on a 10-year term it looks like right now around 2%. Which is pretty good considering inflation, but pretty good. It's just wildly good. All right. So it turns out I don't think the Federal Reserve is the only reason interest rates are low right now. So let me give you the case for two other reasons why interest rates might be low. And this will give you a sense of why some economists are less worried or are thinking interest rates might be low for a long time, rather than just as a short-term thing because the Federal Reserve is being aggressive. The Federal Reserve is part of it, and the European Central Bank, Bank of England, central banks all over Western Europe have been very aggressive in lowering interest rates as well. But it's not just central banks. So let's talk about demographics. If you think about interest rates, the interest rate is set on the basis of we got a whole bunch of people saving money and a whole bunch of people borrowing money. Turns out in the US right now, we have a much bigger population than we had 40 years ago of people who've spent a whole career saving money, right? And we have fewer people borrowing money just because of the age, just because of the demographics, right? So baby boomers are now sitting on more savings probably than they've ever had in their lives. They're in early retirement. I mean, all right, so it's a big, some are late retirement, some are just retiring, but it depends how you draw the lines. But that means that wave of earning, we have huge increases in savings just because of that demographic pattern and fewer people borrowing for homes and for other kinds of things. The other thing, the big thing that's happened that's created a kind of flood of savings is this big shift from pensions to retirement savings accounts in IRAs and 401ks, right? Because if your company offers you a pension, what they're doing is they're making you a promise. Now that's a liability on their part, but they didn't have to early for reasons that were really problematic in retrospect. They didn't have to save money for that, right? It could just be a promise. And the promise was based on whether or not the firm would still be around in 30 years or 50 years. But that means those savings weren't sitting there in the economy funding other investment. They were instead maybe funding investment in that firm. Then we made a shift and we decided for very good reasons that a pension fund, a company should have to save for that, because otherwise if the company goes out of business, right, all the pensioners are out. But also retirement savings, partly as a result, retirement savings shifted very dramatically over to people investing their money or getting a sort of a set amount of money put into a 401k or a 403b or something like this. This just means that the way we're funding retirement savings now is causing a much bigger push of money into financial markets. There's just lots and lots of money in the stock market, in bond market, internationally, domestically, and then government bonds. And all of this money is being offered, just sort of searching in financial markets for something to do, something productive to do. Banks are trying to find people to borrow the money. Bonds, it's loans to firms. The stock market is financing expansion of those firms as well. And it looks like there just isn't as many good places for that money to go. So what we're seeing is, so this is my third point, is we have these fewer good opportunities. This is really hard to measure, but some economists are arguing that today there are just fewer good places for the money to go. There's less low-hanging fruit in terms of investment returns in developed economies in the US and in Western Europe than there was 50 years ago. But there's just less low-hanging fruit. There's less stuff out there to invest in, fewer businesses, both because of demographics, but also because of technology and infrastructure that's now really well built up. And the result is that there aren't as many places for that money to go. And where the debt is actually going is like higher education, it's homes that are more and more expensive, and other kinds of things which aren't having the same productivity effect, right? And anyway, so that gets a little more complicated, but there's less money than going into sort of productive. There's less firms making as big sort of high profit borrowing with a high return. Now, what all this means is the story is that with fewer good opportunities for this money to sort of go into, and with more money going into these financial markets, the end result is that interest rates are just going to be kind of permanently low for a period of time. And if you believe this story, and I believe it like 4 out of 7 days a week, all right? So if you believe this story, then what you would expect is maybe in 30 years, things would look very different, but in 10 years, they probably wouldn't. And you might think that for this to shift, a lot of the financing would probably have to move out of richer countries, and we'd have to do a lot more of our savings in parts of the world that are developing more rapidly. So if you were interested in saving all of your money in Southeast Asia, you might be able to get a higher return. If you're interested in saving your money in China, where growth rates have been remarkably high for the last 50 years, you might get a higher return. But there's real problems moving your money in and out of China, so that's not a real option for folks. But the investment returns in the Western world are just not going to be as high. This is the way the story goes. And that's kind of a permanent thing then. That's a structural change in the economy. We had a good run. It was 150 years. It was fun. And now we should expect low rates of return and therefore low interest rates for the foreseeable future in the US. That's the argument. If you believe that, then borrowing money is kind of permanently going to be cheap. Okay, before I go into inflation, are there other questions? I haven't been watching the clock at all because I'm having fun. Just a second. So how much more time do we have scheduled?
We typically wrap right at 11. So you have about 17 minutes.
I do this to my students every time. I'm like, don't you guys just want to stay an extra hour? I'm having fun. All right, so we're going to talk about inflation then. So here's the inflation rate. This is measured through consumption expenditures, and it's complicated. I won't tell you how it's measured. It's like the consumer price index, but it's a little better. So this is the inflation rate over the same period of time that we've been looking at before. And what you see is inflation was really high in the 1980s. It's been falling, and it's been really low, below 3% for the last couple of decades. But then we have a big spike. And the last data we have in these numbers is January of 2021. And so we've got a little more data since then, not much, but it looks like that's gone up a little bit further. I mean, we don't have the official data yet, but that's the signal. So we have historically high rates of inflation right now. And this actually just shows you, this isn't even the most dramatic numbers that we could look at there. But that raises the question. There's a lot of folks that worry about government spending and borrowing and the impact on inflation. And so I wanted to explain why this is a concern. And there's kind of two kind of arguments we can make here. And one would be that governments that borrow a lot of money are going to start to realize that there's no way they're going to pay it off. And then they get the itch to spend money, right? And they have these really high debt payments, but they still really want to go to war. So what do? They just start printing money. And it's this sort of crisis-fueled money printing in a period in which you have high debt that has caused the worst scenarios of hyperinflation around the world. Whenever you see hyperinflation, usually there's a war. There's some kind of existential crisis, economic crisis behind it. If it's not a war, it's some other kind of really big crisis. And governments they're out of options, and they just start printing money to stay in business, basically, or to pay the troops or to keep things going. In a less dramatic note, for the US, we're not quite worried about that because our financial system is pretty easy. There's lots of ways for the US government to get money. We wouldn't probably have to print money to get out of a crisis. But there is a concern that there's a political pressure to allow higher rates of inflation just because it's an easy way to pay bills. All right, so that's one concern. I don't think that's a big concern with the US federal government, or at least financial markets right now don't seem to think that's a big problem. We have not seen financial markets signaling that they're worried more about inflation with recent debt levels, which I think is interesting. The real concern in recent years with inflation is not the debt, but the spending. So when the US federal government is spending lots of money aggressively, then we have the worry that there's just going to be more money in the economy chasing fewer goods and services. And that is what we're seeing in the last year. So what I want to show you here is real personal disposable income. So this is adjusted for inflation. This is on average across the country, the money people have available to spend on things. You'll notice the last couple of years have been wild. And just right in the middle of the recession, right, it spikes by about $2,000 on average per person. Now that should sound pretty familiar. That's about what the US federal government handed to every adult in the US, right? All of a sudden, everybody had $2,000 more to spend. But it's, of course, it's not just that. It's also the higher unemployment benefits and other kinds of things. So the weirdest thing about the last recession is lots of people lost their jobs, but incomes on average didn't fall because we decided this is going to be a recession where we actually just don't want people to go back to work right away because of the pandemic. So we're just going to shovel money everywhere we can find that will take it. And this is what we get, right? We get a whole bunch of people with more disposable income in the middle of a crisis than we would have expected. At the same time, the economy was slowing down. In a structural way, in the sense that it wasn't just that the economy was slowing down because people were discouraged. There were just fewer people to do things, and there were fewer businesses that were open to make things. And of course, this was happening around the whole world, and hence the supply chain problems, right? There's limited goods getting into manufacturing, or limited materials getting into manufacturing to allow them to produce their final products. There's lots of ways we could display this, but I think the simplest way is just to show the number of people who are showing up for work on any given day, which is what we have here. This is the labor force participation rate for all adults in the US. And what we see is this is moving along and slowly increasing right around 63%. The pandemic hits, it drops down. Oh geez, these numbers are too small. Who made these graphs? Down to 60%. And then rebounds. We get about half of that loss in workers jumps back right after the pandemic, but we never recover, right? We're still millions of workers below what we were in 2019. That's retirements. That's people whose kids weren't in school, so they had to stay home. That's people that just quit because they didn't like their job and they had additional money coming from the government, or they decided they could make it on lower incomes. This doesn't account for people working fewer hours, which is also a thing that's been happening. In the last few periods, we've seen this ticking up a little bit, but we're still just down people. So we have more money and less stuff being produced, and we get inflation. And the inflation has been the worst in those particular markets where we have the supply chain shortages, right? Where we have the issues where they're just, it's in cars, right? Because of microchips and other things I don't fully understand. And it's in things that are involved in the shipping, and it's the raw materials like lumber were really short for a period of time. And those are the worst. And then we can also talk about gas prices, which kind of touch everything. But the underlying structural problem is just lots of money chasing a smaller economy. All right, so that causes our inflation. What am I worried about? I am worried about inflation continuing. If this kind of gets baked in and continues for another year at high rates, then we have to take extraordinary measures to pull inflation back and actually slow down the economy. And that would hurt a lot of people, right? That's what we had to do in the 1980s. I'm not 100% sure how the Federal Reserve would resolve that problem if inflation continues, but if it does, that would be there'd be a lot of pain involved in dialing it back. I'm worried about dramatically higher interest rates, right? If that story about permanently low interest rates, if that's wrong, and interest rates 5 years from now or 10 years from now are sitting up at 3 or 4% when the federal government goes to borrow money, which would be very high. But if something like that happened, then all of a sudden the debt is a big problem, right? But mostly I'm worried about the fact that we haven't seen any indication from our leaders in Washington that government borrowing or debt is something that they are going to worry about, right? We see some politicians taking a brave stand for like a whopping 2 days when there's some spending bill or something of the sort, but there's no political consensus that fiscal responsibility is a thing that we need to be worried about. And that just makes me really uncertain about how to think about future government spending and taxes and borrowing, because I don't see the built-in political mechanisms to try to dial back the kind of spending we've seen in recent years. I could be wrong. Maybe I'm being pessimistic, but I don't think so. And that's where I wanted to end. I'm sorry, I wanted to end about 10 minutes earlier than I did, but we've gotten a lot of questions already, but I'm happy to take more.
In your opinion, what kind of incentive would it take for Congress to want to do something about it?
You know, there's two ways to think about this. One is that the American people do not appear to care. And if the American people do not appear to care, then politicians will not care, right? We care a lot more about the culture war flashpoints than we do about the government budget deficit. And on the left, politicians care a lot more about the programs they want to put in place, probably for good reasons. And on the right, people care a lot more about the taxes they want lowered, probably for good reasons. But those spending programs and the tax decreases are both more popular than a politician coming out and saying something like, we need to raise taxes and borrow less money. There's just no constituency where that's a winning campaign message. So it strikes me that there's a problem with like what we want, right? At a pretty basic level. And so we want this, and our politicians have given it to us. The other problem, though, you might say, is that that means there's probably a structural problem built into our democracy where our leaders, and indeed we, are probably not, in some sense, being held accountable for what the world looks like in 10 or 20 years. I don't know how to fix that. Appointing a king for life might resolve that problem, but I think that would have other side effects. So. But our politicians are on a very short-term election cycle. And so that might structurally create an interest in short-term politics rather than long-term. I don't know how to resolve that.
So in relation to whether or not anybody in Washington wants to control spending, every 18 months or so, the Congress votes to raise the spending level, right? And which has been, you didn't show that graph, but that would be, yep, look like a ski slope. In the meantime, there's a group, I'm not sure how large it is, and that relates to my question, of people that want to do away with having to approve it. We can just borrow as much as we want. Nobody has to approve it. Is that a significant group?
I have really mixed feelings. So you're talking about the debt limit. So Congress has to not only agree to spend money, they also have to periodically agree to authorize the federal government to borrow above a particular limit to fund that government spending. The debt limit is kind of a weird political animal because when the government decides to spend the money, they are, in effect, if they decide to spend the money and decide not to raise taxes to cover it, they are making a choice about borrowing. So the debt limit in politics just plays the role of being like an annual reminder of what we are doing. And it's a really weird kind of brinksmanship politics that it creates, because whoever is in power, it's their response, like whatever party has the majority, it's their responsibility to make sure this debt limit increase goes through. And the other party has every incentive to like throw monkey wrenches in the process and watch whatever party's in power like struggle to try to get this passed because it's unpopular. And we've seen both parties play these games in weird ways. And it's borderline meaningless given the other choices the government is making, and also great political theater. So I don't think the debt limit thing is the issue, because if we didn't increase the debt limit, but we made all the other choices that the government makes, then the answer is just we're going to break promises to people, which the US federal government shouldn't be doing, right? You don't not pay people their paychecks, right? When you've hired them. So I think that whole shenanigan is just a piece of the larger dysfunction. And I don't know whether the debt limit thing itself is the place where we should be like standing our ground. No, what we should be doing is we should be demanding tax revenue to cover the spending that we're doing or something like that, right?
I have a question in the chat. Can you comment on the US's ability to impose financial sanctions on sovereign foreign countries like Russia, and why can't they do it back to us?
That's a really good question. I have no idea. I mean, on one hand, I have some idea, but I'd be kind of speculating, which is not my job. So I'll keep it very short. I'd speculate the US does have as a financial center, we do have legal control over really important financial institutions that Russia has to participate in, and a really big influence on international financial institutions like the IMF. And so by throwing that kind of weight around, anytime the Russian government is holding assets in any US organization, then we have legal control to put limits on the use of those funds. And then we also have the ability to make rules about what US companies and financial organizations can do business with Russia. And so I think that's what sanctions generally mean, is putting limits within the US sovereignty, right, on what people in the US are doing. And that just cuts Russia off from the global financial system in a kind of important way. So Russia could do it, except that we don't care about Russian banks that much. So I think that's my guess, though. You could tell me I'm totally wrong on that.
My question is sort of related with what has happened in the last week or so. The country may be facing now inflation being caused by outside forces. And we as a country may be being expected to make sacrifices in this way, totally without our control. And I don't know if people have the will to do that the way they did it in World War II. So it seems very concerning as to what's going to happen in that area.
I think that might be true. It's really difficult to speculate how this is all going to go. I would say you're right. I think you're alluding to the fact that particularly energy costs could very well go up because Russia is a big player in fossil fuel, natural gas in particular. And that's all in a global market, and oil as well. And so we could see higher gas prices and natural gas and also petroleum. That would have an impact on inflation. It wouldn't be, even if we just cut Russia out, it would be a big increase in prices, but it probably wouldn't be World War II levels of mobilizations required on that. It would just be higher inflation. It'd be more like the early 1970s, I think, in terms of the OPEC thing, and probably not that bad. Now, the question of whether or not the U.S. might be militarily mobilized, and then the cost of that, my sense is that we're probably not looking at, given past military conflicts, we're probably not looking at mobilization in terms of raw dollars required of the US federal government that would be anything like World War II. It would probably look a lot more like Desert Storm and a lot less, or more like Afghanistan and less like World War II, which is an extraordinary amount of money. But given the size of the US government and the current funding of the military, it would be an increase, but it wouldn't be a economy shaking increase. That's just my sense, though. It's really difficult to predict where these things go. If this is World War III, then you're right and I'm wrong. And, we'll pray.
Would you consider coming back and giving us a follow-up lecture?
You know what? I don't think I've ever said no to HASP.
We've had
because it's just so fun. I did something about the environment last year, and I don't know. We did something on inequality a few years ago. I always have a great time. Yes, I'd be happy always to come back.
Yeah, we have similar comments at home. Yeah, thank you, that people would be anxious to hear more insight, more in depth. And so obviously you're being well received and appreciated. We do have 2 minutes left, and it looks like there's a question over there.
Okay.
Would you comment on other countries that had significant debt way beyond like 100% GDP, 200% GDP, and what's happening with their economies?
So there are a couple of examples, and so Greece, there was a really big. You may remember there's a big issue with Greece. Geez, time flies. What was that? 5-7 years ago or something? And so with some countries in Europe in particular, we've seen a lot of pressure to keep debt levels low, in part because the European Union is trying to do some coordination internally among their members to not have and because of the common currency, it just gets all wrapped up in a terrible knot where Greece was kind of out of step with the broader monetary policy in Europe. And so, but also the problem generally speaking, is governments promising lots and lots of money, but then not having the will or the ability to raise taxes to cover it. And that is those kinds of crises. Those usually happen when there's some third thing that comes in, some kind of economic collapse, some kind of financial crisis, something else that triggers sort of this conflicts of problems. And that happened in Greece. But the biggest problems occur when you have both unsustainable spending and an inability to raise money consistently or borrow money, right? People don't want to lend you money because they think you might default, and the government can't raise money through taxes because their tax system just isn't well developed. People are, tax avoidance is rampant, or they just don't have the infrastructure or the government capacity to do it well. And it's when like 2 or 3 of those things happen at once, then you see a crisis where banks or governments are close to default. And then, everybody gets involved and the economist is writing long think pieces on it. But that's just a different kind of situation than the US is in, because we don't have that confluence. That's the short answer.
I think we're out of
think we end there.
time. This
Thank
was
you all.
excellent presentation.
Hey,
Give
it was a
Dr.
lot of fun. Thank you so
McMullen.
much for having me.
Thank you so much. Thank you, everyone at home, for your participation. And I'm going to go ahead and close class. Have a great day.